Australia may not officially be in a recession, but for millions of households, it already feels like one. Groceries are up, insurance is up, rent is up, mortgage repayments are still painful. Businesses are closing, people are cutting back, and confidence across the country is starting to crack. So when economists say, technically Australia is still growing, the average Aussie is asking a very different question. Then why does it feel like we're going backwards? Today we're breaking down whether Australia is actually heading for a recession, why the official numbers don't tell the whole story, and what you should actually do now, before things get worse. Let's start with the technical definition, because this is where the disconnect begins. A recession, by the textbook definition, means 2 consecutive quarters of negative GDP growth. By that measure, Australia is not there. In the March quarter of 2026, the economy still grew by 0.3%, and annual growth came in at 2.5%. But here's the number that actually matters to you. GDP per person fell 0.1% in the quarter. The pie is still growing, your slice of it is shrinking. That's the gap the headlines miss completely. There's a second kind of recession nobody talks about. Call it the household recession. This is when the economy survives on paper, but real households feel poorer in real life. Bills eat more of the pay packet. Savings get thinner. The extras disappear first, then the things that used to feel non-negotiable start getting cut too. And right now, that's much closer to where Australia actually sits. Household spending fell 1.1% in April, with discretionary spending down 0.8% month on month. That is not a confident consumer. That is someone pulling back hard. And confidence, the thing that predicts what happens next, is genuinely weak. The Westpac Melbourne Institute Consumer Sentiment Index fell to 80.6 in June 2026, down from 83 in May, one of the weakest readings in the survey's long history. Consumers remain deeply pessimistic, with cost of living pressure front and centre, and growing fear about family finances over the year ahead. Here's why that matters more than people realise. When Australians feel squeezed and uncertain, they don't just complain, they spend less. They delay big decisions. They get cautious. And that caution spreads through retail, through small business, through the whole economy. Now let's talk about inflation, because the headline number is hiding the real story. Headline inflation eased to 4.2% in the 12 months to April 2026, down from 4.6% in March. So technically, inflation is no longer accelerating. But look at what's actually rising. Housing costs up 6.3% over the year, transport up 6.6%, rents up 3.5%, and electricity a staggering 22.5%. You're not buying more. You're paying more for the exact same life you had last year. Housing is still the centre of the strain, and the numbers here are genuinely concerning. National dwelling rents rose 2.1% over the quarter and 5.7% over the year to March 2026. Renters are now spending a record 33.1% of gross median household income on rent. Vacancy rates remain extremely tight at 1.6% nationally, with every capital city below 2%. That is not a normal housing market. That is a market where 1 in 3 rental dollars goes straight to keeping a roof over your head, with almost nowhere to move if your circumstances change. Businesses are feeling it too, and that matters for jobs. The latest NAB monthly business survey says business confidence rose in May, but only to -14. Business conditions were unchanged at 3, still below the long-run average. In plain English, businesses are operating, but cautiously. Margins are tight. Confidence is negative across every industry. That's exactly the backdrop where hiring slows and investment gets delayed before it shows up in the headline unemployment number. Speaking of which, the jobs market is softening. Let's be honest about how much. The unemployment rate rose to 4.5% in April 2026. Employment fell by 18,600 people in the month, but hours worked still increased by 0.8%. So this is not a collapse. It's a slow weakening at the edges, fewer jobs, but the jobs that remain are demanding more hours. That's not catastrophic, but it's not nothing either. And here's the genuinely reassuring part, because not everything in this picture is grim. The RBA says most households and businesses remain resilient, and the vast majority of borrowers would still be able to service their debts even under adverse scenarios. This is not shaping up like 2008. There's no banking crisis brewing underneath this, but resilience and comfort are not the same thing. You can be technically coping and still feel financially exhausted every single week. Both things are true for a lot of Australian households right now. So why isn't the Reserve Bank just cutting rates to give people relief? The cash rate target remains 4.35% as of the 17th of June 2026. The RBA's near-term inflation outlook has been revised higher, with headline inflation expected to peak at 4.8% in mid-2026, and underlying inflation expected to stay above 3% until mid-2027. The bank is genuinely boxed in. Cutting rates too early risks reigniting inflation that's still running hot in the categories that hurt households most. Holding rates keeps pressure on mortgage holders and renters alike. There's no clean exit here in the short term. So where does this actually go from here? There are three real paths. The soft landing. Inflation gradually eases, the labour market weakens only modestly, rate relief eventually arrives, and households slowly get breathing room without Australia ever technically entering recession. The drawn-out household recession. GDP stays barely positive, per capita growth stays weak, consumers stay pessimistic, housing stays unaffordable, and daily life keeps feeling worse than the official numbers suggest. The genuine technical recession. Weak confidence turns into deeper spending cuts, businesses pull back harder, unemployment rises sharply, and GDP finally tips negative for 2 straight quarters. Based on everything in the data right now, the second scenario is the most believable. Not a collapse, not a boom, a long, grinding squeeze where the official numbers look mediocre, but ordinary life feels considerably worse. So what do you actually do if this is the environment we're in? Stress test your budget honestly. Don't plan around the hope that rates drop quickly or bills suddenly ease. Plan for the squeeze to continue. Protect your cash buffer. In a slow, grinding downturn, liquidity is everything. Even a modest emergency fund stops a bad month becoming a bad year. Attack high-interest debt fast. Credit card debt is far more dangerous when growth is weak and living costs stay elevated. Be cautious about new fixed costs. This is not the moment to overextend unless your income is genuinely secure. And prepare for a softer job market before it becomes obvious. Update your CV now. Stay close to your network. Build options while you still have the time to build them. In this kind of economy, resilience beats optimism every time. So, is Australia heading for an official recession? Maybe. But for a lot of households, that's the wrong question entirely. The better question is whether Australians are already living through a recession-like reality, even though the official trigger hasn't been pulled. And looking at per capita growth, confidence, inflation in essentials, rents, and spending, it's genuinely hard to argue that millions of households aren't already there. If this gave you a clearer picture of what's actually happening, subscribe to the channel and hit the notification bell. And